Hey everyone, it's Luis and welcome back to the channel. Today, we're diving into a really critical topic for anyone thinking about buying a home, especially if it's your first time, the dreaded house poor syndrome. This is when you're technically a homeowner, but so much of your income is eaten up by your mortgage and other housing expenses that you're left with barely anything to live on, save, or invest. You've got the house, sure, but you can't afford to actually enjoy life or build wealth beyond your four walls, and that's a stressful place to be. I recently came across an example that really highlights this problem. A couple was spending a staggering 66% of their combined take-home pay just on their house. Think about that. 2/3 of every dollar they brought home was immediately gone, just to keep a roof over their heads. That leaves very little room for groceries, transportation, unexpected repairs, let alone saving for retirement or even a small vacation. It's a recipe for constant financial anxiety, and unfortunately, it's a situation far too many people find themselves in because they stretch too far for that dream home. So, the big question we're tackling today is, how do you avoid this trap? How can you, as a first-time homebuyer, make a smart, sustainable decision that sets you up for financial success, not stress? We're going to break down a clear, actionable strategy to ensure your home is a blessing, not a burden. We'll cover everything from figuring out your true budget to understanding all the hidden costs. Because I want you to buy your home with confidence and peace of mind. Let's get into it! Alright, so the very first mistake I see a lot of first-time homebuyers make is taking the mortgage pre-approval amount from the bank as gospel. The bank tells them they're approved for, say, $500,000, and they immediately start shopping for $500,000 houses. But here's the thing, you absolutely need to understand. The bank's number is their risk assessment, not your comfort level. Their main goal is to lend money and make interest. They're not necessarily concerned if you're eating ramen noodles for the next 30 years to make the payments. They run their calculations, often based on gross income and fairly loose debt-to-income ratios, and come up with the maximum they're willing to lend you. You need to be much, much more conservative than that. What you need to do, and this is non-negotiable, is run your own numbers. Sit down and create a detailed, realistic budget based on your actual take-home pay. That's the money that hits your bank account after taxes and deductions, not your gross salary. List out all your current expenses: rent, food, transportation, utilities, entertainment, subscriptions, student loans, car payments, everything. See what you're truly spending each month. Only then can you start to figure out what you can comfortably allocate towards housing without sacrificing your entire lifestyle or other financial goals. Don't just guess, track your spending for a month if you have to. This detailed personal budget is your foundation. Once you have a clear picture of your current spending and your take-home pay, you can start thinking about PITI. That's principal, interest, taxes, and insurance, the four main components of your mortgage payment. My strong recommendation, and what I tell everyone, is to keep your total PITI below 35%, or at the absolute maximum 40%, of your monthly take-home pay. Notice I keep emphasizing take-home pay. Many traditional guidelines use gross income, but that's misleading because you don't live on your gross income. Using take-home pay gives you a much more realistic and safer limit for your housing expenses, ensuring you have breathing room. So, you've figured out a comfortable monthly PITI based on your take-home pay. Fantastic. But hold on, because the mortgage payment itself is just one piece of the homeownership cost puzzle. So many first-time buyers get a nasty shock when all the other expenses start rolling in, and these can add up significantly. The first two big ones, right after principal and interest, are property taxes and homeowner's insurance, which are part of PITI. Property taxes can vary wildly depending on your location and the assessed value of your home, and guess what? They can, and often do, go up over time. Homeowner's insurance is also mandatory, protecting your investment, but its cost can also fluctuate. Next up, if you're looking at a condo, townhouse, or a home in certain planned communities, you're likely going to have HOA dues, homeowners association fees. These can cover things like landscaping, common area maintenance, and sometimes even certain utilities. HOA dues can range from a couple of $100s to many hundreds or even thousands per month in some luxury buildings, and they too have a tendency to increase annually. Then there's the big one that many people underestimate: maintenance and repairs. Trust me on this, something will break. It could be a leaky faucet, a dishwasher dying, or much bigger ticket items like needing a new roof after a storm, the HVAC system giving out in the middle of summer, or a water heater bursting. These aren't if they happen, but when. And finally, don't forget about utilities. If you're moving from a smaller apartment, your utility bills for water, gas, electricity, trash service, and internet could be substantially higher in a larger single-family home. You're heating and cooling more space, you might be watering a lawn, and so on. It's crucial to research average utility costs for the type and size of home you're considering in your target area. You need to add all of these: property taxes, insurance, potential HOA dues, a realistic monthly estimate for maintenance. A common rule of thumb is 1% of the home's value per year, divided by 12, and utilities to your PITI to get your true total monthly housing cost. Buying a house is exciting, but it's also one of the biggest financial commitments you'll ever make. And often the process of saving for a down payment and closing costs can leave your savings account looking pretty depleted right when you get the keys. This is precisely why having a robust emergency fund after you close on the house is not just a good idea, it's absolutely critical. As a homeowner, your financial responsibilities increase significantly. You no longer have a landlord to call when the plumbing backs up or the air conditioning dies. Those expenses are now entirely on you, and they can be substantial and honestly pretty unexpected. Your emergency fund is your safety net. The standard advice, which I wholeheartedly agree with, is to have 3 to 6 months worth of essential living expenses saved in an easily accessible liquid account. And let me be very clear here, this means 3 to 6 months of all your essential bills. Your new total housing payment, which includes principal, interest, taxes, insurance, plus all those extras we just talked about, food, transportation, utilities, insurance premiums, minimum debt payments, everything you absolutely need to live. This fund is there to cover you in case of a job loss, a medical emergency, a significant and unforeseen home repair, or any other major financial curveball life might throw your way. Without it, you could be forced into debt or even risk losing your home. Now, it's really important to distinguish this emergency fund from other savings. The money for your 3 to 6 month emergency fund should be separate from, and in addition to, any funds you've set aside for the actual moving expenses, new furniture, paint, initial small repairs, or any decorating you plan to do right after moving in. Don't make the mistake of depleting your emergency reserves to buy a new sofa or spruce up the place. Those are planned expenses you should budget for separately. Your emergency fund is sacrosanct. It's for true unforeseen emergencies only, ensuring you can weather financial storms without derailing your homeownership journey. When you're buying a home, especially your first one, it's easy to get caught up in the excitement of the present moment. You're thinking about paint colors and where the sofa will go, but a mortgage is typically a 15 or 30-year commitment, and a lot can change in that time. So it's vital to consider your future flexibility when deciding how much house you can afford. Your income today might be stable, but what if you or your partner experiences a job loss, decides to switch to a lower-paying but more fulfilling career, or wants to take time off to raise a family? If your housing payment is already stretching your budget to the max, you'll have zero wiggle room for these kinds of income fluctuations. Beyond potential income changes, think about your other long-term financial goals. Are you still able to comfortably contribute to your retirement accounts like a 401k or IRA after factoring in your new housing costs? What about other savings goals like investing in the stock market, saving for your children's education if you plan to have them, building up a fund for a new car, or even just having money for travel and experiences? If your house payment is so large that it suffocates your ability to save and invest for these other important aspects of life, you're essentially trading future financial freedom for a slightly bigger or fancier house today. That's a trade-off that many people come to regret. And then there are the unexpected life events that can impact your finances. Perhaps you'll have a new baby, which comes with a whole host of new expenses. Maybe an aging parent will need financial assistance, or even need to move in with you, requiring adjustments to your living space and budget. Or you could face unexpected medical bills not fully covered by insurance. A home that you can truly afford, one that doesn't push your budget to its absolute limit, provides you with the financial resilience and flexibility to navigate these life changes without undue stress. The goal is for your home to be a source of stability and comfort, not a financial anchor weighing you down when life inevitably happens. Navigating the world of mortgages and home financing can be incredibly complex, especially for first-time buyers. There are so many different loan types, terms, and potential pitfalls. That's why one of the smartest first steps you can take, even before you start seriously browsing Zillow or attending open houses, is to talk to a reputable and experienced mortgage loan officer or mortgage broker. I'm not talking about a generic bank teller, but a dedicated mortgage professional whose job it is to guide you through this process. They can look at your entire financial picture, your income, debts, savings, credit score, and give you a realistic assessment of what you can truly afford from a lending perspective, and more importantly, help you understand the implications. Getting pre-approved for a mortgage is a crucial step in the home buying journey. A pre-approval letter shows sellers that you're a serious, qualified buyer, which can give you a significant advantage in a competitive market. But a good mortgage expert does much more than just hand you a pre-approval letter. They will take the time to explain the different loan options available to you, things like conventional loans, FHA loans, Virginia loans if you're eligible, USDA loans, and the pros and cons of each. They'll break down how interest rates work, the difference between fixed rate and adjustable rate mortgages, and explain all the associated fees and closing costs, so there are no surprises later on. This expert guidance is invaluable. A good loan officer will also reinforce the importance of understanding your total ownership costs, going beyond just the principal and interest to include taxes, insurance, and potential private mortgage insurance if your down payment is less than 20%. Don't be afraid to ask them a ton of questions. That's what they're there for. You want to understand every line item, every term, every commitment you're making. Their job is to help you secure not just any loan, but the right loan that fits your financial situation and long-term goals, helping you avoid predatory lending practices and ensuring you step into homeownership with clarity and confidence. So, let's bring it all home. We talked about that couple spending a massive 66% of their take-home pay on their housing. Even if they have assets tied up in the house, that kind of cash flow situation is incredibly risky and undoubtedly stressful. It leaves absolutely no margin for error, no room for life's unexpected turns, and certainly no capacity to build wealth or enjoy financial freedom. Being house poor is a trap you want to avoid at all costs, because owning a home should enhance your life, not suffocate it financially. The key takeaways here are pretty straightforward but incredibly important. Always run your own numbers and aim to keep your total housing costs, that's principal, interest, taxes, insurance, plus HOA, maintenance estimates, and higher utilities, ideally under 35% and no more than 40% of your actual take-home pay. Bolster this with a strong emergency fund of 3 to 6 months of essential living expenses, kept separate from your moving and furnishing budget. This financial discipline will be your shield against becoming house poor and will provide you with much-needed peace of mind. Ultimately, the allure of owning that perfect dream home right now can be strong, but it's not worth sacrificing your long-term financial health and stability. Be patient, be realistic, and be smart about your numbers. A slightly smaller home or one in a different neighborhood that fits comfortably within a conservative budget will serve you far better than a McMansion that keeps you up at night worrying about payments. Your future self will thank you for making a responsible choice today. If you found this helpful, make sure to hit that like button, subscribe for more content, and let me know your thoughts or questions in the comments below. And if you want expert guidance on your home journey, visit wherehomeconnect.com or call 888-317-3515. Your future starts with the right advice.